Good afternoon, everybody. This is Steven with the Padernacht real estate team of Keller Williams, and we are back for another episode of Mortgage Matters. Today is December 6th, 2024, and let's check to see. We are on episode 26. Let me get my snazzy little thing going across the bottom, little ticker. There we go. Episode 26. This is Steve Padernacht with Keller Williams once again. And I am going to bring on my co-host, Christian Babcock. Christian, what's up, man?
What is up? How we doing?
I'm doing great. How are you?
I'm good. I got my camera stepped up in the 21st century here.
Dude, it's like I'm looking at you in like 4K.
It's the way the Lord intended it.
Dude, and honestly, like from 10 minutes ago, the lighting looks... The next step, dude, I'm telling you, we go for these lights, and you are going to a regular star.
That's it. Wait till I open my new office with the whole green screen wall, and then we're gonna be. I'll be. All right. It's a work in progress.
Yes, it is. How you doing today?
I'm good. How you doing?
I'm good. Talk to me about mortgage news. What's going on? I'm seeing up, down. What's the story, man?
Story of my life. Yeah, that's what the story is. It's So a little kind of context. We were dipped into the fives for a second, back in August, September, and then was shot right back up to about 7% last month, right before the election. I know we were online when that happened. So now we're starting to see, rates come down slowly the last couple of days, and, maybe last week, a little bit of a trend back downward. So, averaging on a 30-year mid to low sixes again, which is good. It's heading in the right direction, and, if we can get like a mid six as opposed to a 7.
Yeah.
If we can get back down into the, high fives, that would be fantastic. But again, it's still wait and see. Right now, obviously, we know that there's a major, policy changes and regime change in Washington, which is, and a lot of appointees. Some of those appointees are looked at favorably for mortgage rates. So we'll see.
And some aren't.
And some are, and some aren't. And and I will not get into any of that.
It's just hilarious to me how half the world is rejoicing and half the world is over here crying.
It's really bad. But listen, I always just say, like, I'm just happy that that's that many people paying attention, because
very true.
I know when we were younger, I was I was the only one out of my friends that even had any kind of eye on politics. And that was really because of my father. My father was really into watching politics and watching what was going on, even locally, federally, everything else. So we were always talking about politics in my house, but I was like on an island with my friends. Now all of my friends are talking about it, which is, I'm like, oh, thanks. Where you been the last 30 years? So it's good. Again, awareness is great. People realizing that, these policy changes do impact your life directly.
Yes.
It's not just, they're all liars and they're all full of it, but it doesn't mean anything. Yeah, it does. And when you go to the grocery store, and that's when you realize it, or when your kids might, are learning things in school or whatever, these things, these people do impact your life.
I think I might have said this on an episode with you before, but I read this somewhere, I heard this somewhere, I can't remember, but somebody was saying, oh, I'm not into politics. And then the guy said to him, well, do you stop at red lights? And
I've heard that.
That's politics. Like everything is affected, like everything that we're doing on a daily, weekly basis, it's affecting. And now, as we're getting older, and obviously you and I are both in the business, so it affects us and our clients even more. And we are now looked at as sources of information.
Right.
People are owning homes, people are buying, people are selling, and these policies are affecting them. So just I urge everybody just to pay attention and understand what's going on, whatever side of the aisle you're on.
Doesn't matter which side, it doesn't matter, and whatever your politics are, whatever your personal politics or personal opinions are, does not matter. But, you got to get out there and vote, and, vote your conscience and vote your mind, and whatever it is you believe in, that's the way you vote. So
yeah, Yeah, I know. And just sitting here doing this live cast with you every single week or almost every single week, it just
Mhm.
really kind of spotlights how important it is just to stay on
Mhm.
up to date with everything, right?
Right. Well, in my world, especially with mortgage rates, and especially in the last couple of years, I mean, every week there's something happening that's impacting mortgage rates, either bad or they're good or bad, and very violently. In some
Yeah.
cases. I mean, I was just telling somebody, again yesterday that in my 22-year career, and I've said this before on here, that I've seen maybe one or two drastic increases by 0.5% in a couple of days. That was like the sky was falling, and that happened. And that was like once a year, maybe. This is like a weekly thing now. It's we're up that we're up an eighth, we're down an eighth, we're up a half, we're down a half, we're up a full 1%, then we're down another 0.5%. And everything in between. And it's really tough to navigate these waters in this market. Keep your sanity, keep your clients happy, but even more important, keeping your clients qualified. I mean,
Yeah.
people don't realize too that when you're if somebody's pushing their approval to the very brink at one interest rate. If it goes up a quarter or 0.5%, they could be in the middle of the process. And if that rate wasn't locked in, they're not going to close, or they're going to end up paying hefty fees to buy the rate back down to where it was, so it could be even that significant that somebody might not even get the loan that they're currently approved for. So.
And we've talked about this before, but I'd like to just kind of harp on it. Give me some tips and tricks for keeping your clients qualified.
I mean, for me, it's fairly simple. I just don't push them to the last decimal point of their approval. I mean, I always ask people what they want to spend first versus giving them a maximum amount that they qualify for. And then I try to find that number based on what they want to spend. And usually people want to spend a lot less than what we could qualify them for. So I usually am not in that mess a lot of times.
Yeah.
But there are other circumstances. Sometimes you do have 2 or 3 people that are actually helping pay the housing expense, but for one reason or the others, the one or 2 of the other people just can't be on the loan, whether they have bad credit or whatever, or they work off the books or like whatever their situation is. So that would be a reason why somebody might be pushing their numbers right to the very limits, but can still actually make the mortgage payment in reality. But it's just knowing the local taxes, knowing, what goes into an actual mortgage payment here locally and figuring out where people want to be and just not pushing them to the absolute maximum.
Well, also no big purchases, right?
Well, yeah. So no, when you're especially in the middle of that's where you were going with that. Yeah. I mean, no big purchases. If you're in the middle of a deal, don't go out, get a new car. Don't spend all your money that you were going to use for your closing costs. Don't jack up your credit cards. Because if you don't want to be. What people don't realize is right before we close, and we get it every once in a while. People think they're like we're not going to check again after the loan is approved, but no, they do check right before you close. They run a soft pull of your credit to see if any of the expenses have changed. And the last thing you want to do is be at the finish line and then realize that your debt ratio now just got blown up because you took a new loan out or something like that. So that's a big one.
And possibly you wouldn't qualify under the mortgage contingency umbrella at that point.
Right. Well, you've already passed the mortgage contingency at that point, so now you're jeopardizing your down payment if it happens in the end. Absolutely.
Yep. I like to just kind of acquaint for anybody that's maybe new and not, listening, that these things are super important. And it's like you see on Instagram or you'll see on Facebook or whatever, all of these guys who come on there and say, hey, it's so easy to buy a house, get a loan from here, do this. But it's all of the details leading up to that are really the most important thing, and having people that are qualified by your side to be able to help you get to that finish line.
You're right. And I'm actually on a daily basis. I can give you more new examples every time. Like I have a guy right now that I'm looking at the email that he was exact scenario that happened, that he is not getting the loan that he originally was locked in at a very low rate because now his income was miscalculated in the beginning, and it's in this case he's actually over the income limit for Sony May. So now he's being told, "Oh, sorry, we can't get you that. We got to push you into a different loan altogether." Whereas if it was calculated correctly in the beginning, he'd be getting the loan he thought he was getting from the beginning that he's locked in at. So it's the devil is in the details, and there's a ton of guidelines in mortgage. It's not like anything else. It's not like applying for a car payment. It's not like a credit card one-pager application. There's so many different guidelines that if even one is missed, that impacts the debt ratio. The debt ratio is the number one reason why people get declined for mortgages. And that is a fixable problem if you're just working with a loan officer that knows how to do it.
Yeah.
It's very easy.
Here's one for you. Give me the difference between front and back end.
So yeah, and again, I was literally just sent an email 5 seconds ago describing exactly this thing for a co-op buyer. So your front end ratio, or in some cases called your housing ratio, is the percentage of your monthly gross income that goes towards your housing payment, right? So if your debt ratio, it needs to be under a certain level, which in this guy's case is the co-op was requiring that he doesn't spend more than 28% of his income.
Okay.
For his housing ratio.
Yeah.
So I was, so I took his income and I told him, okay, if that's the case, your payment cannot exceed $1,680. That's it. That's 28% of your income.
That's including, that's his maintenance and mortgage?
That's just maintenance and mortgage for the co-op, right? So your front end ratio, which is your housing ratio, is just the housing payment into your income.
Yep.
Your total debt ratio is the reason we run the credit. And, more and more I get people, oh, I don't want you to run my credit. I don't want you to run my credit. And I tell people, like, look, it's not going to hurt your credit, number one. But number two, if I don't have an accurate credit report, I don't know what your accurate other monthly payments are, I can't calculate your total debt ratio, because that's when we add all those expenses to your housing payment and see what percentage of your income is your total debt ratio. Yep. So, and different loans have different requirements. And in this guy's case, again, the co-op that he wanted to buy wanted his front end ratio to be 28. They wanted his total debt ratio to be 33. So, I need all that information to calculate that properly.
Of course. I mean, because you're talking about people who possibly have car payments, maybe they have school loans, and then obviously the inevitable, the credit card debt.
Right.
And credit card debt, correct me if I'm wrong, you're using minimum payments.
Minimum payments. Right.
So, those are they tend to be on the lower side, depending on if you have like a
not now.
Very true.
You can't believe some of the ones that I see. I see people with like a $5,000 credit card balance and payments $300 a month.
Yeah.
Minimum.
Yeah.
Minimum.
Yeah, you're talking about, well, now that I think about it, you're right. I'm thinking of like, there are some the payments out there like $25, $50, $75.
Yeah. A lot of those are a couple $100 balances, which people don't carry anyway. So we usually will exclude those if they're not carrying that balance forward.
Yeah.
But yeah, and I actually make that comparison to people. I'll say, like, you have a $300 minimum monthly payment on a credit card that only has a $5,000 balance. $300 a month is the equivalent of a $50,000 mortgage payment spread over 30 years right now. So just to kind of show you the difference between a 30-year loan and just the minimum interest only payment on a $5,000 credit card with a rate of 20-something%.
Yeah, it literally chokes people.
Yeah, and it is.
So, we talk a lot about how you want to how compound interest helps you, right? Like if you're building in stocks, or if you're building how compound interest, every 7 years it doubles, but we don't talk enough about how the compound interest hurts you on those credit card payments. You're talking about 20% APR on a credit card. They don't even look at it. 20%, no problem. But they don't realize what that actually means.
Well, because unfortunately, a lot of people that are especially when they're living paycheck to paycheck, are looking at their credit card payments just as a carried monthly expense.
That's it. Like it's just there. I know I got to pay $500 a month and whatever.
Right. They're a lot of times they're not even looking or thinking about paying it off. They're just like they're spending the money on whatever they're spending the money on. It's not like they're even spending it frivolously. It's they need it to live in some cases, so they're managing their monthly expenses by those minimum payments. Which is why debt consolidation and everything like that is very helpful, which leads to why you want to own a home, because you can consolidate debt when you have equity in a home. I gave you that example a couple of weeks ago of a guy that I know that I just saved him $3,000 a month on consolidating all the different loans and credit cards and everything that he had with just $100,000 second mortgage, fixed rate second mortgage product that we have.
Yeah, people, again, man, and we talk about this every week until we're like legit blue in the face about how you have to be financially aware of what's going on. We just talked in the top of the show about the policies, but it's also just literally that, like, the smallest things, like print out your bank statement.
Mhm.
Go through your bank statement, like legitimately, and just put like, you know, a check next to the ones that you want to keep, and maybe, you know, circle the ones you want to try to get rid of. You know, I did that recently, and I found so many different subscriptions
Oh yeah.
I had on my phone, like on the in-app purchases. Like I was paying for like these stupid games. Like my nephew over the summertime was like, "Hey, let me get your phone." I downloaded a game from. I didn't even realize I was paying whatever $9.99 a month for the
Yeah.
past 6 months
Yeah.
for him for this game.
Yeah. I was playing Planet Fitness for about 10 years. We never
Oh
ran
Lord,
$10 a month.
they're tough.
I know. I
It
know.
took me like 6 months to get away from them. They're tough. They make you like
You got to show up.
they told me that I had to come into Planet Fitness. I'm like, all right, cool. I went there and they're like, no, you have to go to the one that you signed up in.
Yeah.
Like, dude, that was in Connecticut. Like I am not driving to Connecticut to get this thing taken off. You take it off, or I'm going to report you to the Better Business Bureau. And after fighting back and forth with them, they were able to do it. But those Planet Fitness horror stories are no joke. Like,
I thought you're gonna get sued, so you better take it easy.
You know what, Christian? If we get big enough that Planet Fitness notices us,
Yeah, that's right. That'd be good. We're making it.
Exactly, man. If we get that big. All right. So, what kind of trends? What are you seeing right now? What are you seeing in the market? Are you thinking that? And I'm not asking you for the crystal ball. Our rate's going to go down next year. We're going into 2025. Do you think that the market's going to soften a little? You think more homes are going to come to the market? Because this year we brought less homes to the market. Less homes have sold this year by about, I think it was like less than like 5% than they predicted. So it's under 4 million homes sold.
Wow. Nationally or locally?
Nationally.
Okay. Well, and that's the challenge too, because on a national level, you're seeing places like Florida are already starting to see prices decline in some areas significantly. You know, because their inventory is catching up, but also houses in Florida becoming much more unaffordable because of insurance costs and all those other things, all those other factors. HOA fees are going up on condos and things like that. So every market is kind of its own micro market. Where we live, it's, you know, especially even smaller, where you can have one town or village right next to another one, and it's a completely different market. You know, so I was just speaking to somebody about this earlier today, and exactly that I have. Because I really work with people from as low as, you know, $100,000 co-ops to $3-4 million homes and everything in between. Every one of those markets is different. You know, a $500,000 to $700,000 house right now, if you can even find one, is fiercely competitive. But I'm not seeing people bidding those houses $100,000-$200,000 over the asking price, because it's all relative. They can only go so far. But then there's other ones, $1.5 million house will go to 2 million with no problem, you know, because those buyers just have more money to throw at it, you know. So but I'm still seeing in a lot of cases bidding wars still, you know, in certain markets. You know, houses, you know, with areas that have 1 or maybe 2 months worth of inventory, there's bidding wars on all of them, and you got to be fast. You got to be ready to go. That's why, you know, what we've really been focusing on too is like having your pre-approval ready, updated, you know, with a date that's not 6 months old, you know. So like, because they will pick that apart, and then you're now getting into the bidding, and you're held up if you're trying to go back to your original lender and can't find them. You might not get that house just because you had a pre-approval, but it was 6 months old and they didn't accept your offer because it needed to be updated, and you didn't get it updated in time. Yeah, that's how fast things can go. So, you know, you definitely want to make sure that your pre-approval is accurate and also very recent, and just be ready to, you know, in some cases, you know, I've had agents tell me that the list price is like the reserve price is an auction. Like you're starting there, you know, and you're going up from that. You know?
Well, I'll be honest with you, man. That's like that's a trend that I've really seen really take off this year. It's like you have a $700,000 house, and we're listing it at $600,000 just to create that urgency, like that reserve number at an auction.
That bit, well, you know. Yes, I don't know agents personally if they're listing them that much lower than what they think it's worth just to get it into a bidding war, but they are pricing them competitively and getting them into bidding wars for sure. You know, like, you know, so they're not, but it's, you know, it's, but I see it on the other side. I see it when the clients are coming back to me for an updated pre-approval, and they ask me one for 600, and then the next day, hey, can you increase it to 650? Hey, can you increase it to 700? You know, and so on and so forth. You know, on the same house that they're bidding on. You know, so. which is another reason why I do the pre-approvals the way that I do. Like when I focus on what they want to spend, but then I also do give them that maximum number. Like, hey, like, if you need to go, if you want to end at 700, you should probably start looking at houses that are listed around 600 to get to 700. Like if you don't want to spend more than 700, you shouldn't be looking at houses that are listed for 700. Look at houses that are listed maybe at 650 with the anticipation of getting to 7.
Yeah, I mean, listen, I know you want to get 4 bedrooms, but you might want to look at 3 bedrooms with a finished basement.
Mm-hmm. Yeah. So.
I always, when I'm talking to clients, I say, okay, let's go through your wants and your needs.
Mm-hmm.
Right? Listen, I want to have an island in my kitchen. I want to have a huge backyard, but do you really need it? Like, and when we get to the point that we're looking at houses and you're seeing that the houses with the islands and this and that, they're way out of your price range. Like, it really kind of like, sometimes it takes going and showing them 2 or 3 houses.
Mm-hmm. Yeah.
And them actually seeing them, being like, all right, I get it now. It's like show and tell. You know what I mean?
Oh, exactly. Yeah, but also that's to be like having a partner that when I'm calculating the numbers for him, I'm trying to get him to not waste that time and say like, look, this is what you're telling me you want to spend. So stop yourself. Don't go look at an $800,000 house that you're going to fall in love with when you have a $600,000 budget. Why are you going to do that to yourself?
I swear to you, man. I talk to people and I'm like, they're like, let's go out and look at houses. I'm like, all right, cool. Let's have the, you have a basic conversation. We do LP Mama, location, price, mortgage. So we talk about mortgage. Are you pre-approved? No, but I have a great job and I have this and I have that. All right, listen, here's the story, Mr. and Mrs. Buyer. You're telling me that you want to go look at this house that's listed at $925. The problem is going to be that I'm going to take you and you're going to go look at it. You're going to fall in love with it. Then you're going to have a conversation with the lender. They're going to tell you can't afford it. Then what's going to happen? You're going to look, your hopes are going to be up here and then you're going to let yourself down. Why don't we just do it this way first? See what your buying power is. And then if for some reason the homes that we're looking at don't fit that price range,
right, then you go up.
Then we'll start looking at alternative methods. And it's important that like you and I are in lockstep having that conversation because they're not just hearing it from one person. You know what I mean?
Right. No, exactly right.
How is your team doing? How's everybody doing? They're busy. Everybody's for
this time of year, I got to say we're coming into 2025 with a rock solid pipeline. Yeah, I mean I feel like it was slower. If I look at the application numbers that we have as a branch, we're up on average 20 to 25 more applications month over month from last year.
Nice.
So that's a healthy sign.
Great sign, man, going into 2025. That's a great sign.
Right. And these are all purchases. I mean, there's no refinances really in there. It's all purchase applications. So, there are people buying, and it's a densely populated area. And as I mentioned, I mean, the biggest challenge, and I know we've talked about it somewhat, but I don't know if we focused a ton of attention on them is co-ops is really a big frustration right now because they are really the only affordable option, even more so than renting. And the co-op boards are becoming so restrictive that like, I want to shake some of these co-op boards and be like, this is your time. Like, this is like, you've lived in this co-op for 10 years. Like you can actually make some money now.
Yeah.
But instead, by being so restrictive, they're restricting their own price because, like you can't get people under this criteria, which means the prices are never going to increase. When a high rate environment, they need to loosen up.
I know you're a huge fan of co-ops, and I know you're a huge, and you did really well in your first couple of co-ops. But like for me, I honestly barely even recommend them anymore unless somebody absolutely can't afford.
I was a huge. 3 years ago, I would have described myself as a huge fan of co-ops. Now I'm also less of a fan because now I just see them more as an affordability necessity.
Yeah.
If you want to own something in this area. And that's why it's more frustrating for me because I'm like, they could be a great option for people to make money, but when they're so restrictive to get in, it's turning away a lot of buyers that are now they're burning the reputation of co-ops. Like people just hearing again, like they did in the 80s, like, oh, you don't want to buy a co-op. And if you ask those people, like, why don't you want to buy a co-op? They're like, I don't know. My uncle just told me I should buy one. So that's what's happening. That's what happens with reputation. And it takes a long time to get rid of a bad reputation. And, they're doing it again. Co-ops are, I mean, where else are you going to be able to find a place that you can live for $1,800 a month and get like, and possibly be like a big 1 bedroom or even a 2 bedroom?
Yep.
You know,
And the thing is, these co-op buildings, they're nice, right? You got a pool, you got a doorman, you got the
and the
quality.
locations are all near trains, like everything about them is great except getting in.
Yeah, yeah. And it's not even the getting in part. Like what I tell people is, listen, just so you know, it's not even just getting in. Just think about getting out.
Resale, right, right, right,
Exactly. Think about
right,
getting out and
right,
figuring out how you're gonna, be able to
right.
sell this thing. And
Right. If it's this hard for you to get in, how far is it how going to be for you to get out? Exactly.
yeah.
And I have seen that some places where the co-ops are listed for a year and they've had 20 different buyers in and out of there. And at least now in Westchester, they're putting the guidelines out in front so they can turn, like the people
Mhm.
don't even bother if they don't meet the criteria, which is better than going 2-3 months and then having the board deny them 2-3 months from now.
Yeah.
So for that, it's good, but they're just price wise and as an investment, the boards are just killing themselves. They're shooting themselves in the foot.
You are absolutely correct, though. Like this is their time to shine. Like right now, if they could boost their own values so much, but they
Yeah.
just one thing I've noticed is that a lot of times the co-op values just stay stagnant.
Right, because but that's what I mean. Historically, co-op prices have followed house prices up and down. So
Mhm.
as houses and condos get too unaffordable, co-op prices are still down here. They'll start to come up because they're still much more affordable than a condo or a house. Now they're still down here because they want people to be under a 35% debt ratio with rates that in some cases were like 7%. Like that's just unrealistic.
Yeah.
So they just, they need to say like, all right, you know what, maybe we'll go up to a 45% debt ratio. The mortgage company will allow them to go to 50. Like, let's go to 45. And then when rates drop, most of our people will probably refinance anyway. So let's take it, let's do that. Instead.
And it makes perfect sense, right? Like if the co-op boards increase their numbers up to 40, 45, and the bank is willing to lend them the money and they still have a 700 credit score, they've proven
reserves and everything else, right?
Yeah, like you've proven that you're gonna make your payments. Like you
Right. I would be focused if I was still on my co-op board, that's what I would be focused on. I'd be saying, all right, let's stretch the debt ratio, but let's make sure that maybe they have 12 months of reserves just in case they lose their job. Let's make sure they have over a 700 credit score. Make sure maybe they've been at their job for 2 or more years or whatever. They have a stable employment, and and then call it a day at that. And then hope that once rates drop, these people will lower their payments.
How about that board that we love so much that now is going based off the net income?
Oh yeah. They always did that one. They always did net.
In that building, right?
In that building, yeah.
Which
I mean, look, when you think about it, is a smart way to do it, but it's the same thing. Like, all right, you want net income, and then you want under a 35 debt ratio, like that's right.
Oh man! All right, listen, man. We're coming up on our time. I really, really, really appreciate you. And listen, everybody who is listening in, thank you so much for listening in to us. And follow us on Facebook and on Instagram. And what I'm going to do, Christian, is I'm just going to put your contact information right there for people to see in case they're looking to get pre-approved for a mortgage.
That's it. Beautiful, man. Thank you. Thank you for the equipment.
Oh, man. Merry Christmas.
Thank you.
Later, man.
Later, man.